Hey guys, welcome to Investify, where we help you grow your wealth through smart investments. Today, we're going to discuss some of Charlie Munger's investment strategies and how you can apply them to your own portfolio. Charlie Munger is widely recognized as an investing legend, and following his advice on what makes a great investment opportunity has helped many investors achieve attractive returns. His latest investment in BYD yielded a 15 times return. And I even bought shares of BYD after hearing about his latest buying and selling activities. However, I wasn't as lucky as Charlie Munger and only received a 2 times return on my investment. Munger is famous for his investment approach, which he sums up with his famous quote, "All I want to know is where I'm gonna die, so I'll never go there." Although he couldn't find the place, he applied this approach to the investment world. Munger often found great investment ideas by working backwards. He would create a doomsday scenario for any potential company investment and then analyze how the company would perform in the worst-case scenario. If the company survived the harsh conditions, only then would it qualify as a Munger-grade investment. Charlie Munger is a master investor who has helped Warren Buffett generate returns that have consistently beaten the S&P 500 for many decades. In addition, he made a successful concentrated bet on Costco that yielded a 37 times return for his firm. Therefore, we pay close attention to his investing wisdom when crafting our own portfolios. In this video, we'll examine 3 specific pieces of his investing advice and recommend some high-yielding picks that fit in with Charlie Munger's wisdom and can earn some handsome returns for investors. Let's start with Munger's tip number 1. Buy stocks that are easy to value. Munger explains that value investing involves finding a mispriced gamble and knowing whether the gamble is mispriced. To do this successfully, it's important to stick to investments within your circle of competence. For the average retail investor, it's best to focus on easy-to-understand investment theses, such as defensive businesses that generate stable cash flow, grow predictably, and pass on cash flow to shareholders through dividends and/or buybacks. Examples of such industries include REITs, midstream energy companies, utilities, and BDCs. Moving on to Munger's second tip, he advises investors to buy high-quality businesses. Munger explains that a great business at a fair price is superior to a fair business at a great price. Great businesses have superior competitive advantages, making it easier to apply Munger's first tip with less uncertainty about their future earnings stream. Additionally, great businesses often surprise to the upside due to their established track record of building a great corporate culture and employee team that can innovate and overcome challenges, and creating new growth opportunities. Companies like Amazon, Apple, and Tesla are examples of great businesses that have delivered superior long-term results. Finally, Munger's third tip is to buy businesses that play the long game. CEOs should prioritize the long-term well-being of the company instead of using short-term financial engineering techniques to appease Wall Street analysts. Examples of companies that have fallen into stagnant growth due to a short-term focus include IBM and AT&T. Investors should look for companies that prioritize long-term growth and sustainability. As for recommended 2 picks that fulfill Munger's wisdom and can provide handsome return, starting with Realty Income, or O, is a great fit for a portfolio looking to batten down the hatches for a recession. It has a phenomenal balance sheet, a battle-tested recession-resistant business model, excellent management, and a very impressive track record. S&P Global Ratings affirms Realty Income at A-. Foreign currency LT credit rating. Outlook stable. Its conservative triple net lease business model has proven its mettle through numerous economic cycles, including the COVID-19 outbreak and the Great Financial Crisis. Its management skills is evidenced by the REIT's phenomenal track record of growing its dividend for 26 straight years, making it a dividend aristocrat and growing its FFO per share in 25 out of the past 26 years. As a result of all these qualities, it should not be surprising that its total return performance has absolutely crushed the S&P 500 since going public. Last but not least, O is now available to investors at a reasonable price thanks to its recent share price dip. Its enterprise value over EBITDA is presently 17.13x, which is below its 5-year average of 19.41x. Its price over adjusted FFO is 16.02x, also below its 5-year average of 18.52x. Additionally, its dividend yield is currently at 4.8%, exceeding its 5-year average of 4.4%. Considering the imminent recession and expected peak in interest rates, investing in O may be a smart decision for cautious investors like Munger. Another suitable option is Stag Industrial, a real estate value-add investor that specializes in undervalued properties and secondary markets. Their Q3 results showed cash rent growth of 13.6% for lease-over-lease and 5.6% for same-store cash NOI growth. Rent rates for new leases in Q3 grew 19.4%, and lease renewals had a growth rate of 9.5%. Such growth momentum could offset some of the potential recession headwinds. Stag has a wide margin of safety in their investments, allowing them to weather economic downturns effectively. They leverage their scale, industry contacts, and knowledge to add value to the properties they invest in. Moreover, Stag stock is presently priced attractively compared to its historical averages. With lower ratios for price to FFO, price to ATHO, and EV/EBITDA, its price to NAV ratio also suggests a discount compared to its historical trading patterns. Overall, O and Stag are both undervalued high-quality real estate businesses following a recent sell-off. Considering the potential for an upcoming recession and changing interest rates, investing in defensive stocks like these might be a wise decision. How about you? Do you have any other defensive stocks that you believe would be suitable investments for risk-averse investors during an economic downturn? I would be interested in reading your thoughts and experiences in the comment section below, and I'll be sure to respond. And if you found this video helpful, please feel free to share it with your friends. That's it for today. Thank you for watching. Don't forget to like this video, subscribe to our channel, and ring that notification bell for more updates here on Investify.